Your Social Security check went up this year. You heard the announcement, a 2.8% cost of living adjustment for 2026, which for the average retiree meant roughly $56 more every single month. $56. That is not a life-changing number, but it is something. A little extra breathing room, a few extra trips to the grocery store, a small cushion against the inflation that has been eating into fixed incomes for years. And then January came, and your check arrived, and something was wrong. The number was not what you expected. The raise you were promised, the raise the Social Security Administration announced in October, the raise that made headlines across every financial news outlet in the country, that raise had been quietly, automatically, without any warning or fanfare, partially taken back before a single dollar ever hit your bank account. Medicare Part B premiums went up by $17.90 per month in 2026, from $185 to $202.90. That is a 9.7% increase, 3.5 times larger than the 2.8% Social Security COLA you received. For the average retiree, that $17.90 Medicare increase consumed nearly a third of the $56 raise before the check even cleared. And for millions of lower-income seniors whose Social Security benefit is below the average, the Medicare premium increase actually exceeded the dollar amount of their entire COLA raise, meaning they ended the year with less money in their check than they started with, despite being told they received a raise. That is what this video is about. And by the end of it, you are going to understand exactly how this happens, why it keeps happening, and what specific strategies you can use to fight back. Before I get into the numbers and the strategies, I want to make sure you understand the mechanism that makes this possible. Because most retirees know that their Social Security check went up and their Medicare went up, but very few people understand exactly how these two systems interact in a way that guarantees Medicare will always win. Here's how it works. If you are enrolled in both Medicare Part B and Social Security at the same time, which describes the overwhelming majority of Americans age 65 and older, your Medicare Part B premium is not billed to you separately. It is automatically deducted directly from your Social Security benefit before the payment is deposited into your account. This means that every month, the Social Security Administration calculates your gross benefit, subtracts your Medicare Part B premium, and sends you the remainder. You never see the full amount. You never have the option to pay Medicare separately and keep your full Social Security check. The deduction is automatic, mandatory, and invisible to most retirees until they actually sit down and look at their Social Security statement carefully. This arrangement has been in place for decades, and it creates a structural situation where any increase in Medicare Part B premiums directly and immediately reduces the net Social Security income that lands in your bank account. When Medicare premiums rise faster than Social Security COLAs, which has now happened 3 years in a row, retirees effectively lose ground financially even while technically receiving a cost of living adjustment. The raise exists on paper. The money does not arrive in practice. Now let me give you the exact verified numbers from official sources, because I want you to be able to verify everything I tell you independently and share these facts with family members or a financial advisor. According to the Centers for Medicare and Medicaid Services official fact sheet released in November 2025, the standard monthly premium for Medicare Part B rose from $185 in 2025 to $202.90 in 2026. That is an increase of exactly $17.90 per month. Annualized, that is $214.80 more per year in Medicare premiums alone. At the same time, the Social Security Administration announced a 2.8% cost of living adjustment for 2026. For a retiree receiving the average Social Security benefit of approximately $2,000 per month, that 2.8% COLA translates to roughly $56 per month, or $672 over the course of a full year. So the net math looks like this. You gained $56 per month from COLA, you lost $17.90 from Medicare, and your actual take-home increase was approximately $38.10 per month. According to research published by the Center for Retirement Research at Boston College, the Medicare premium increase in 2026 ate up over 25% of the entire Social Security cost of living adjustment. And this is the base case for retirees subject to IRMAA surcharges, which I will explain in detail in a moment. The situation is dramatically worse. I need to spend a moment on why this keeps happening, because understanding the structural cause is what allows you to plan around it rather than just being surprised by it every January. Social Security COLAs and Medicare premium increases are calculated using completely different formulas that measure completely different economic forces, and they are set on completely different timelines. The Social Security COLA is calculated using the Consumer Price Index for urban wage earners and clerical workers. commonly called the CPI-W. This index measures general inflation across a broad basket of goods and services that working-age Americans typically purchase. The problem is that this basket does not accurately reflect the spending patterns of retirees, who spend a significantly larger proportion of their income on healthcare than working-age Americans do. According to the Bureau of Labor Statistics, healthcare represents roughly 13% of a typical retiree's budget. But the CPI-W gives healthcare a much lower weighting because it is designed to measure working-age spending patterns. Meanwhile, Medicare Part B premiums are set based on projected healthcare costs, specifically 25% of the estimated total outlays for Medicare Part B services in the coming year. Healthcare inflation has been consistently and substantially outpacing general inflation for decades. The result is a permanent structural mismatch, a system where retirees' income adjustments are calculated using a formula that underweights the very expense category that is growing fastest. This is not an accident of policy. It is a feature of the system that has been documented, studied, and debated for years without a legislative fix. Now I want to explain IRMAA, the Income-Related Monthly Adjustment Amount, because for a significant portion of retirees watching this video, IRMAA is making the Medicare premium problem dramatically worse than the base numbers I just described. Most people have heard that Medicare Part B costs $202.90 per month in 2026. What most people do not realize is that this is the base rate, and it only applies to individuals with a modified adjusted gross income of $106,000 or less, or married couples with a MAGI of $212,000 or less. If your income is above those thresholds, Medicare charges you a surcharge on top of the base premium, and the surcharges are substantial. In 2026, for a single filer with income between $106,000 and $133,000, the total monthly premium is $259.70, $57 above the base rate. For income between $133,000 and $167,000, it jumps to $368.50. At the highest income tier, above $500,000 for single filers, the monthly Part B premium reaches $689.90 per person. That is nearly $8,300 per year per person just for Medicare Part B. And critically, IRMAA surcharges are calculated based on your tax return from 2 years prior. Your 2026 Medicare premium is based on your 2024 income. This 2-year look-back creates situations where a retiree who had an unusually high income year 2 years ago, due to a one-time Roth conversion, a large IRA withdrawal, the sale of a property, is now paying elevated Medicare premiums even though their current income is much lower. Let me walk through a real example of how the Medicare premium squeeze works in practice, because I think the combination of COLA reduction and IRMAA can be genuinely shocking when you see the full picture laid out. Take a married couple, both age 72. Their combined income in 2024 was $250,000, partly from pension income, partly from a large IRA withdrawal they made to cover some home renovations. That income level puts them in the second IRMAA tier for 2026 Medicare premiums. So instead of the base rate of $202.90 each per month, they each pay $368.50, a surcharge of $165.60 per person above the base, or $331.20 extra per month for the household. Over a full year, this couple is paying nearly $4,000 more in Medicare premiums than a neighbor with the exact same health coverage simply because of one income spike 2 years ago. At the same time, their Social Security COLA increase of 2.8% added perhaps $110 per month to their combined household benefits. Medicare consumed 3 times that amount. Their net monthly income from Social Security effectively declined by over $220 despite receiving a cost of living adjustment. This is the IRMAA trap, and it catches thousands of retirees every single year who did not plan their income with the 2-year Medicare look-back period in mind. Now I want to shift to what you can actually do about this, because this video is not just about explaining a problem, it is about giving you the tools to fight back. The first and most powerful strategy for addressing the Medicare premium squeeze is something called a IRMAA appeal, formerly known as a Medicare Income-Related Monthly Adjustment Amount Life-Changing Event Appeal. Here is how it works. Because IRMAA surcharges are based on your tax return from 2 years prior, there will be situations where your income in the current year is significantly lower than it was 2 years ago, because of retirement, job loss, divorce, death of a spouse, or a one-time income event that will not repeat. In these situations, the Social Security Administration has a formal process that allows you to request that your IRMAA surcharge be recalculated based on your more recent, lower income. The form you need is SSA 44, titled Medicare Income Related Monthly Adjustment Amount, Life-Changing Event. You fill out the form, document your qualifying life-changing event, estimate your current year income, and submit it to your local Social Security office. If approved, the SSA will recalculate your Medicare premium based on the lower income figure, and you will immediately begin paying a reduced premium. If your appeal is successful and you overpaid in earlier months of the year, you may receive a credit. This process is not widely advertised by Medicare or the Social Security Administration, but it is a fully official, legitimate process that saves qualifying retirees hundreds or thousands of dollars per year. The second major strategy for fighting the Medicare premium squeeze is Roth conversion planning specifically timed to avoid IRMAA thresholds. And this is where retirement tax planning and Medicare cost management intersect in a way that most retirees never think about. Remember, IRMAA is calculated using your modified adjusted gross income from 2 years prior. If you do a large Roth conversion in 2026, that conversion amount gets added to your 2026 income, which means it will determine your 2028 Medicare premiums. If the conversion pushes your 2026 MAGI above an IRMAA threshold, you will pay elevated Medicare premiums for all of 2028, so the sequencing of Roth conversions relative to IRMAA thresholds matters enormously. The strategy is to convert up to, but not over the IRMAA threshold that applies to your income level. For a single filer in 2026, the first IRMAA tier begins at $106,000 in MAGI. That means you want to keep your total 2026 income below $106,000 if possible to avoid any IRMAA surcharge in 2028. If your income is already at $80,000 from pension and Social Security, you have approximately $26,000 of Roth conversion capacity before you hit the first IRMAA tier. Use that space strategically, convert up to the limit every year during your low-income years before required minimum distributions begin, and push your income higher. This approach lets you move money to Roth, pay taxes at a controlled rate, and avoid triggering Medicare surcharges simultaneously. There's a third strategy that connects directly to IRMAA management, and that is the Qualified Charitable Distribution, the QCD, which I have covered in previous videos but which deserves specific mention in the context of Medicare premiums because of a benefit most retirees overlook. When you take a required minimum distribution from your traditional IRA and it shows up in your adjusted gross income, it pushes your MAGI higher, potentially into an IRMAA tier, and raises your Medicare premiums 2 years from now. But when you satisfy that same RMD obligation through a qualified charitable distribution by directing the money from your IRA directly to a charity, that amount never enters your adjusted gross income. It satisfies your RMD, it supports a cause you care about, and it keeps your MAGI lower, which protects your IRMAA status 2 years into the future. In 2026, you can do a QCD of up to $111,000 per person directly from a traditional IRA to a qualifying charity. For a retiree with an RMD of $30,000 who is already near an IRMAA threshold, doing a QCD for that entire amount instead of a regular distribution could be the difference between paying the base Medicare rate and paying an IRMAA surcharge that costs hundreds of dollars per month. The QCD is one of the most powerful but least understood tools in retirement tax planning, and in this context it does triple duty, satisfies your RMD, eliminates tax on the distribution, and protects your Medicare premium rate. I also want to address the Part A deductible because most people focus entirely on Part B premiums, but Part A costs are increasing too, and they can hit in ways that feel even more sudden and surprising. Medicare Part A covers inpatient hospital care, hospitalization, skilled nursing facility stays, hospice, and some home health care. Unlike Part B, Part A does not have a monthly premium for most retirees who worked and paid Medicare taxes for at least 10 years. But it does have a deductible, and in 2026, that deductible is $1,736 per benefit period. A benefit period begins when you are admitted to a hospital and ends when you have been out of the hospital or skilled nursing facility for 60 consecutive days. This means that if you are hospitalized twice in the same year, with a gap of less than 60 days between stays, you could potentially owe the $1,736 deductible twice. Many retirees assume that Medicare Part A covers hospital stays completely after they have paid into the system their whole working lives. The reality is that the out-of-pocket exposure from Part A can be substantial, especially for retirees who do not have supplemental Medigap coverage or Medicare Advantage plans that include additional hospital coverage. When you add the Part B premium of $2,434.80 per year, the Part B deductible of $283, the Part A deductible exposure, and potential Part D drug plan premiums, the total out-of-pocket Medicare cost for a typical retiree can easily reach $5,000 to $8,000 per year before a single medical service is rendered. Now I want to talk about a longer-term structural issue that directly affects what retirees can expect from Social Security COLA increases in future years. Because the Medicare premium problem is not going away, and in fact, the trajectory suggests it will get worse before it gets better. According to the Center for Retirement Research at Boston College, Medicare Part B premiums as a share of the average Social Security benefit reached an all-time high of 9.4% in 2026. Think about what that means. Nearly a dime of every dollar of Social Security income for an average retiree now goes directly to Medicare Part B before anything else. In the year 2000, that share was around 5%. Over 26 years, it has nearly doubled. The driving force behind this trend is healthcare inflation, the cost of physician services, outpatient hospital care, diagnostic testing, and prescription drugs administered in clinical settings, all of which are covered under Part B. These costs have been rising at rates that consistently exceed general inflation for decades, and demographic trends suggest the pressure will continue as the baby boom generation ages and utilizes more medical services. The political reality is that fixing this structural mismatch by either reforming how Social Security COLAs are calculated or by creating stronger controls on Medicare premium growth requires congressional action that has proven extremely difficult to achieve. Retirees who plan their finances assuming that their Social Security income will keep pace with their living costs through COLA adjustments alone are likely to be disappointed. Let me give you a specific framework for evaluating your own Medicare and Social Security situation, because I think one of the most valuable things I can do in this video is help you stop thinking about these two programs in isolation and start thinking about them as a connected system that requires active management. Step 1. Get your Social Security statement. You can access it online at ssa.gov by creating or logging into your My Social Security account. On that statement, you will see your monthly gross benefit amount before Medicare deductions. This is the number the government uses to calculate your COLA, and it is typically higher than the net amount you actually receive. Many retirees only ever look at the net number in their bank account and have never checked their gross benefit. Step 2, get your Medicare premium letter. Every November, Medicare sends a letter stating your Part B and Part D premiums for the coming year and whether you are subject to any IRMAA surcharges. If you have not seen this letter or cannot find it, you can call Social Security at 1-800-77-21213 and ask for your current premium amounts. Step 3, calculate your effective net COLA. Take your gross COLA increase in dollar terms, subtract your Medicare Part B premium increase, and subtract any IRMAA change from the prior year. The remainder is your actual net raise. For many retirees, this number is significantly lower than the headline COLA percentage suggests. I want to address something that comes up frequently in conversations about Medicare premiums and Social Security: the question of whether it is worth delaying Social Security to get a higher benefit that is less susceptible to being eaten by Medicare premiums. This is a nuanced question, and the answer depends on your specific situation. But let me give you the framework for thinking about it. Every year, you delay claiming Social Security past your full retirement age, up to age 70, your monthly benefit increases by approximately 8%. So a retiree whose full retirement age benefit is $2,000 per month would receive approximately $2,640 per month if they wait until 70. That larger base benefit means the same 2.8% COLA in dollar terms is larger, about $74 rather than $56. And while Medicare still takes the same $1,790, regardless of your benefit size, the Medicare premium represents a smaller percentage of a larger benefit. A retiree receiving $2,640 per month keeps approximately 93% of their gross benefit after paying the base Medicare premium. A retiree receiving $1,500 per month keeps only 87%. This does not mean delaying Social Security is always the right strategy. It depends on your health, your financial needs, your other income sources, and your break-even timeline. But in the specific context of the Medicare premium squeeze, a higher Social Security base benefit does provide somewhat more resilience against premium erosion. There is one more dimension of this problem I want to address that almost never gets discussed in mainstream financial media, and that is the impact of the Medicare premium squeeze on surviving spouses. When one spouse dies, the surviving spouse transitions from married filing jointly tax status to single filer status, in most cases beginning the year after the death. This change has two compounding negative effects in the context of Medicare premiums. First, the surviving spouse now has only one Social Security benefit instead of two, typically the larger of the two benefits, while the smaller one disappears. Second, the IRMAA thresholds for single filers are dramatically lower than for married joint filers. A married couple can have a combined MAGI of $212,000 and pay the base Medicare premium. A single filer hits the first IRMAA surcharge at just $106,000. So a surviving spouse whose income in the first year of single filing includes pension income, Social Security, investment dividends, and any IRA distributions may suddenly find themselves subject to IRMAA surcharges they never faced while married, even though their actual income has dropped significantly due to losing one Social Security benefit. This is sometimes called the widow or widower tax trap. And it is a Medicare premium dimension of that broader problem that adds significant financial stress to what is already an emotionally devastating life event. Proper estate and retirement income planning with this scenario in mind, specifically structuring income sources to minimize the single filer IRMAA exposure, is one of the most valuable things a financial advisor can do for a married couple in retirement. Before I give you your action items, I want to step back and put this entire Medicare premium squeeze issue into proper perspective because I do not want you to walk away from this video feeling hopeless or angry without a clear path forward. The structural problem is real. Medicare premiums have been rising faster than Social Security COLAs 3 years running, and the underlying healthcare cost dynamics suggest this pressure will continue. But there are meaningful actions you can take that will make a real difference to your net retirement income over time. The retirees who navigate the Medicare premium squeeze most successfully are the ones who treat their Medicare premiums as a variable that can be actively managed, not a fixed, inevitable cost that simply happens to them. By understanding IRMAA thresholds and managing income to stay below them through Roth conversions, QCDs, and careful withdrawal sequencing, you can control what tier of Medicare premiums you pay. By understanding the IRMAA appeals process and using it when your income drops, you can avoid overpaying during low-income years. By understanding the 2-year look-back and planning major income events, large IRA withdrawals, property sales, Roth conversions, with their Medicare implications in mind, you can avoid unpleasant premium surprises. None of these strategies require extraordinary sophistication. They require awareness, planning, and the willingness to look 2 years ahead rather than just at the current year. That is what separates retirees who feel in control of their finances from those who feel like the system is working against them. Here is your complete action plan starting today. First, log into ssa.gov and pull up your Social Security statement. Find your gross monthly benefit amount before Medicare deductions. Calculate what your 2.8% COLA increase was in dollar terms. Now subtract $17.90 for the Medicare Part B premium increase. That is your real net raise. Second, find your Medicare IRMAA determination letter from November 2025. If you are paying any surcharge above the base $202.90 premium, identify what income from 2 years ago triggered it. Third, if you had a significant income reduction in 2025 compared to 2024 due to retirement, job loss, death of a spouse, divorce, or loss of pension income, download SSA Form 44 from ssa.gov right now and begin the IRMAA appeal process. Do not wait. Every month you delay is a month of overpaid premiums. Fourth, calculate your projected 2026 modified adjusted gross income. Compare it to the IRMAA thresholds: $106,000 for single filers, $212,000 for married joint filers. If you are near or above a threshold, identify what income reduction strategies are available to you before December 31st. Qualified charitable distributions for your RMD, reduced IRA withdrawals, deferral of other income. Fifth, if you are not yet on Medicare and are still deciding when to claim Social Security, factor the Medicare premium squeeze into your claiming age decision. A larger base benefit provides more resilience against premium erosion over time. Subscribe to this channel because next Tuesday, I'm going to cover the complete IRMAA appeal process step by step, the exact form, the exact language, and the exact documentation that gets these appeals approved. See you there.